Welcome back to the channel. Today we are talking about Cameco Corp, ticker CCJ, for the second quarter 2026. Cameco's earnings collapsed 92% year over year, and honestly, almost none of it is what it looks like. We are doing this video in two parts. First, I'll grade the report, then walk you through how I'd trade it. Okay, let's get into it. This is not financial advice. Everything in this video is just my own opinion for educational purposes only. Trading involves risk and your results may vary. So on the headline, revenue came in 10% ahead of estimates, which is a solid top-line beat and tells you the uranium pricing story is actually working the way management said it would. But then you flip to EPS and it's down almost 64% versus estimates. And I know that number looks brutal, but before you panic, almost all of that gap traces back to one thing. Last year's second quarter had about $170 million from a Westinghouse reactor project in the Czech Republic that just doesn't repeat this year. Strip that out and the core uranium business is actually up around 5% on a 6-month basis. So on the beat itself. And remember, we're grading against what the underlying business actually did, not the Dukovany distorted headline. This earns a C. A 10% revenue beat is real. The EPS miss is largely an accounting comp issue, and once you clean it up, the core operation is roughly flat to modestly better. And on consistency, this earns a C. Cameco's track record of hitting the number has been uneven, and this quarter doesn't really change that picture either way. Let's talk about the positives from the report. Uranium realized prices climbed to almost $68 a pound, up 18% year over year, and that's the whole story here. Cameco has market-related contracts that reprice as uranium spot prices firm, and they are firming. Management actually raised the full-year outlook on realized price, revenue, and cost of sales. In a quarter with an ugly headline, they had the confidence to lift the numbers going forward. That's a signal. They also held production guidance flat at 19.5 to 21.5 million pounds, even after flooding disruptions in Saskatchewan and post-quarter issues at Cigar Lake. Reaffirming through operational noise is a real conviction move. The Cigar Lake ownership increase closed this quarter, which means Cameco now owns more of one of the best uranium mines in the world. That's a structural upgrade to the earnings power story. And the contract book gives them commitments averaging over 28 million pounds a year for the next 5 years, with above-average commitments through 2028. So near-term revenue visibility is locked in, but they preserved upside through the market-related pricing. So on profitability, this earns a C+. Uranium realized prices are up 18% and the raised outlook is a real positive, but blended production and purchase costs jumped 36%, and fuel services margins compressed from 35% down to 28%. The pricing story is winning, just not by as much as it should. Now let's talk about the negatives from the report. Cash from operations dropped 72% year over year to $131 million, and for the full first half, it's down 81%. That's a real deterioration in cash generation, and it's the number I'm watching most closely going forward. Uranium sales volumes fell 18% and production dropped 15%. Management is framing this as a deliberate lower volume year, not demand weakness, but the numbers still show up on the print. Purchased uranium costs jumped to over $91 a pound, which is nearly triple their production cost. That pushed blended costs up 36% and compressed segment margins in a quarter where pricing should have carried them further. Westinghouse swung to a $10 million loss versus a $126 million profit last year. Now that's mostly the Dukovany project rolling off, but with that gone, the segment is now leaning on the AP 1000 pipeline and other long-dated catalysts to deliver. And fuel services adjusted EBITDA margin compressed from 35% down to 28% on lower sales volumes. Segment EBITDA fell 26%. Smaller business, but still a real headwind. On guidance, this lands at a B+, because management raised the 2026 realized price and revenue outlook and reaffirmed production despite 2 operational hiccups. Raising guidance in a noisy quarter takes conviction. And on red flags, I'm at a C. The cash conversion drop is the one thing I can't dismiss. If Westinghouse doesn't rebuild in the back half, the consolidated free cash flow story stays pressured, even with uranium pricing tailwinds. Putting it all together, this is one of those prints where the headline optics are ugly, but the underlying business is quietly getting better. The uranium thesis got stronger, higher realized prices, unchanged production guide, raised outlook, and expanded ownership of a Tier 1 asset. The Westinghouse comp headwind is a known one-quarter optics problem that rolls off by mid-2026. The one real concern is the cash flow drop, and that's what I'll be watching next quarter. Overall, I'm giving this print a C+. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding, find the one that best fits your situation. Okay, let's get into it. For me, the raised 2026 realized price outlook and the reaffirmed production numbers tell me I do not need to chase this thing. If it dips after the print, that is my window to start legging in. Instead of buying shares outright, I would rather sell cash-secured puts, sitting about 8 to 12% below the post-print price. That way, I collect premium while I wait for a better entry. The noisy headline could hand me a temporary discount that the improving uranium story does not really justify. I'm happy to get paid to sit and see if it comes to me. So my play here is simple. I sell puts below the print and let the premium do the work. When I am selling puts here, my floor sits at strikes that could survive a rough scenario. Think Westinghouse, cash conversion, staying weak in the back half, and a small production tweak at Cigar Lake, so 10 to 15% below current price. My ceiling, the highest strike I would sell, only goes up near the post-print price if I would genuinely be thrilled to own the shares there. Otherwise, I stay lower and more defensive. The raised outlook and that £28 million per year contract book give me real downside support on the long-term thesis, so I feel okay leaning into these strikes. Bottom line, I keep my floor low, and my ceiling only creeps up if I would happily take assignment there. If these are my shares, I am holding. The release actually confirms the multi-year uranium thesis I bought into, with the raised outlook and the bigger Cigar Lake ownership stake. On top of that, the Department of Energy conditional commitment on the AP 1,000 reactors was not really priced into the stock going in, so that is a bonus tailwind I get for free. The only time I trim is if shares rip on headlines without uranium spot prices following along, because that second quarter cash flow drop of 72% year over year means the near-term optics are still messy. So I hold, and I only trim if the stock rips for reasons the uranium tape does not back up. If these were my covered calls, I would widen my strikes and push the duration further out. The raised revenue and realized price outlook, plus long-term uranium strengthening, tell me capping upside with tight, near-dated calls is a mistake here. If my existing calls are getting close to the money, I would roll them up and out rather than just letting assignment happen. I do not want to give away shares into strength. Even though the headline earnings collapsed, the actual fundamental setup improved on this release. That is the thing I am pricing off of, not the noisy print. So for me, it is widen the strikes and push the expirations further out. If these were my long-dated calls, I am holding. Nothing in this release breaks the 12 to 24 month thesis I got in for. If anything, the story got better. The Cigar Lake ownership increase, the AP 1000 pipeline expanding to as many as 91 opportunities, and the raised 2026 outlook all strengthen the setup I bought into. The Westinghouse Duchovny comparison headwind is a one-quarter optics problem, plain and simple. It is not a structural change to the long-term earnings power story. So I hold because the thesis actually got stronger on this print. If I am underwater or thinking about adding, this release actually validates the original bull thesis, rather than breaking it. Realized uranium prices are up 18% year over year, which is a real number. The production forecast was reaffirmed, the outlook was raised, and the Tier 1 asset ownership expanded with the Cigar Lake move. Those are the pillars I bought in for. The operating business is materially healthier than the 92% headline net earnings decline suggests, and the Duchovny distortion rolls off the comparisons by the middle of 2026. So averaging down is defensible here, as long as my position sizing already left room for this noise. Bottom line, this print earns a C+ from me. The headline miss is largely accounting noise. The underlying uranium business is stronger than the numbers suggest, and the multi-year thesis is intact. Thanks for watching, and I'll see you on the next one.